Throughout my 50 years of experience in financial markets, some of the most surprising moments occurred when events unfolded that I had never witnessed in my lifetime. However, when I studied history, I discovered that such events had actually happened many times before. For example, I studied the Great Depression period from 1930 to 1945. This historical perspective allowed me to develop a systematic approach to navigating economic challenges, which proved invaluable during the 2008 financial crisis. Currently, three major developments have prompted me to delve deeper into these historical patterns, leading to my book Principles for Dealing with the Changing World Order. The first of these is the unprecedented level of debt creation and monetization, comparable only to the 1930 to 1945 era. The second is rising internal conflicts fueled by significant wealth and value disparities. This growing populism, both on the left and the right, has created irreconcilable tensions that, while not necessarily leading to armed conflict, could result in a form of civil war marked by governmental dysfunction. This phenomenon is not limited to the United States, but can also be observed in other parts of the world. The third major development is the intensifying great power conflict. History shows that dominant powers often establish new global rules after winning wars, as happened in 1945. This leads to periods of peace and prosperity until emerging powers, such as China today, rise to challenge the established order. In addition to these three key trends, there are two other critical factors that I refer to as part of the Big Five. The fourth factor involves acts of nature, such as droughts, floods, and pandemics. Historically, these natural events have caused more deaths and toppled more systems than wars or internal conflicts. Finally, the fifth factor is revolutionary technological change. Transformations like the Industrial Revolution have had profound impacts on societies, and we are now experiencing similar shifts with advancements in AI and other groundbreaking technologies. Together, these Big Five forces are reshaping the world. Before delving deeper into their implications, I'd like to introduce a segment from my video, The Changing World Order, which elaborates on these ideas. The video I want to show you runs for about 40 minutes, but I'll be sharing just 4 minutes of it to illustrate the cyclical patterns that tend to repeat throughout history. When I refer to a cycle, I don't mean that events are predestined to occur in a specific way. Rather, cycles are shaped by cause and effect relationships. These relationships can be analyzed and measured, enabling us to anticipate potential future outcomes. In my book, Principles for Dealing with the Changing World Order, I explore this pattern by examining the last 500 years of history. My research covers the 10 most powerful empires during that time and the histories of the last 3 reserve currencies. This includes the rise and fall of the Dutch Empire and the guilder, the British Empire and the pound, the United States and the dollar, and the decline of the Spanish, German, French, Indian, Japanese, Russian, and Ottoman empires. I also studied the fluctuations in power and currency dominance within the Chinese dynasties, tracing back to the year 600. To simplify this complex history, I focus on 4 key empires: the Dutch, British, US, and Chinese. These empires reveal overlapping cycles of approximately 250 years each, with transitional periods of intense conflict lasting 10 to 20 years. Historically, dominant powers don't lose their positions without resistance, leading to these turbulent transitions. The strength of an empire in my study is measured using 8 metrics: education, innovation and technological advancement, global market competitiveness, economic output, share of global trade, military strength, the prominence of its financial capital markets, and the strength of its currency as a global reserve. By averaging these metrics, I could evaluate a country's overall power, observe its rise and decline, and identify patterns across centuries. The sequences from these various empires reveal a consistent pattern in the rise and fall of nations. To make these patterns easier to understand, I've simplified the data to highlight the critical cause and effect relationships. Typically, strong education systems lead to greater innovation and technological progress. This often results in a nation achieving reserve currency status for its currency. But over time, these same drivers tend to erode in reverse order, reinforcing the decline. The internal sequence of events that drives this rise and fall often begins after a major conflict, such as a war, that establishes a new leading power and world order. Following such upheaval, there's usually a prolonged period of peace and prosperity. As people grow accustomed to this stability, they tend to take it for granted, borrowing heavily under the assumption that it will last. This excessive borrowing often leads to the formation of financial bubbles, setting the stage for the next downturn in the cycle. An empire's share of global trade expands, and as its currency becomes the standard for most transactions, it gains reserve currency status. This further amplifies its monetary influence. However, this prosperity often leads to an uneven distribution of wealth, widening the gap between the wealthy and the less fortunate. Eventually, the financial bubble bursts, prompting the printing of more money and intensifying internal conflicts between the rich and the poor. These tensions often culminate in some form of revolution aimed at redistributing wealth, which can occur peacefully or escalate into a civil war. As internal strife weakens the empire, its global influence diminishes, leaving it vulnerable to rising external powers. When these emerging powers grow strong enough to challenge the dominant but struggling empire, external conflicts, often wars, become inevitable. These internal and external conflicts ultimately produce winners and losers. The victors then come together to establish a new world order, restarting the cycle. Let's delve into what I call the big five forces shaping this process. First is the creation of debt. The mechanics of debt creation are similar for individuals, businesses, and governments, with one critical distinction. Governments can print money to repay their debts. In essence, debt is an obligation to return borrowed money, and if managed well, it rewards both lenders and borrowers. Lenders earn a return through interest, while borrowers face manageable rates. However, as debt accumulates relative to income, the system becomes unsustainable. Currently, high debt levels, particularly in the United States, but also globally, pose significant challenges. The demands of social programs, military spending, and other obligations exceed available resources. This leads to an ongoing cycle of rising debt relative to income. Central banks have exacerbated the situation by purchasing debt and absorbing it into their balance sheets, creating a precarious long-term risk. While this issue may not be the most immediate concern, it is deeply interconnected with other forces driving the cycle. The second force is internal conflict, which has become especially pronounced in recent years. Societal divisions are widening, fueled by both moderate and extremist factions within political parties. On the right, policies under leaders like Trump have leaned toward nationalism, isolationism, and protectionism, favoring corporations and the wealthy. Meanwhile, left-leaning policies often focus on different priorities. Despite their differences, both sides broadly agree on adopting a more assertive stance toward China. The third force is the ongoing great power conflict, particularly between the United States and China. Both nations face distinct challenges, and their rivalry is shaping the global landscape in profound ways. These great power dynamics, combined with the interplay of all five forces, create a complex and evolving cycle that defines our ERA.I in China's case. Significant debt issues stem from the real estate sector, which has created broader economic challenges. President Xi has described an approaching once-in-a-century storm, reflecting the gravity of the domestic issues the country faces. Among these challenges, climate remains a persistent concern, alongside financial issues and a shift toward a more centralized and autocratic approach to governance. This consolidation of power further shapes the nation's trajectory. In contrast, the United States is grappling with internal conflicts and political polarization, which carry significant implications for the global landscape. Historically, economic conflicts often precede military ones. While I don't have any privileged insights into potential military confrontations, the current situation with Taiwan is a notable point of tension. The long-standing One China policy is not sustainable indefinitely, leading to uncertainty and international scrutiny. Questions are arising among global investors regarding potential repercussions from their respective governments. For example, American investors in China might face restrictions or adverse policies from the US government, while China could also impose challenges for foreign investors. Additionally, ideological debates within China are creating uncertainty about the future of its market economy. Issues such as property rights, the promotion of common prosperity, and the role of wealth in society are under scrutiny, contributing to an evolving and unpredictable environment. These dynamics are also affecting global economic flows. Chinese producers, for instance, are shifting production to other countries, not only within ASEAN nations like Vietnam, but also in regions such as Mexico. This shift is altering the global trade landscape. There's also a growing risk of economic sanctions and counter-sanctions between nations, which could have devastating consequences for the global economy. Despite these risks, Chinese assets remain attractively valued. Companies like Bridgewater have found success investing in China over recent years, demonstrating that there are still viable opportunities in the region. The fourth major influence is climate change. China, like the rest of the world, is contending with the effects of droughts, floods, and pandemics, which have historically been significant disruptors. Addressing climate change is projected to cost around $8 trillion annually worldwide, approximately 8% of global GDP. These costs will come from efforts to limit temperature rises, develop new technologies, repair damages, and build protective infrastructure such as seawalls. Climate change will also reshape migration patterns and have widespread economic and social impacts. Finally, the fifth influence is technology. We are currently experiencing what may be the most significant industrial revolution in history. Reflecting on past innovations like the printing press, which revolutionized the sharing and building of knowledge, we see parallels in today's technological advancements. Just as the transition from the agricultural age to the industrial age brought profound economic changes by enabling machines to replace human labor, today's technological developments are driving transformative economic growth and reshaping industries on a global scale. The digital revolution has already transformed the world in countless ways. But now we are entering an even more profound technological era with advancements like artificial intelligence. AI touches every aspect of life, enhancing thinking processes, increasing productivity, and performing tasks more efficiently and cost-effectively than humans. However, technology also has the potential to be weaponized, making it a double-edged sword. We are stepping into an era filled with possibilities, but one that also carries risks we cannot fully predict. These five key forces – technology, economic shifts, climate change, geopolitical tensions, and internal conflicts – are interconnected and collectively shape this era of heightened uncertainty. In navigating these complexities, diversification emerges as a critical strategy. Effective diversification is more powerful than even the best decision-making because it significantly improves the return-to-risk ratio. In fact, with good, uncorrelated return streams, diversification can enhance this ratio by a factor of 5. Diversification should encompass multiple dimensions, including countries, asset classes, and currencies. Broader diversification ensures resilience against various risks and uncertainties. When assessing countries for investment or financial stability, I focus on 3 essential criteria. 1. Financial health asterisk, does the country earn more than it spends? A solid income statement and a healthy balance sheet are crucial for managing challenges effectively. 2. Productivity and collaboration asterisk, is the environment conducive to fostering competition, innovation, and productivity through strong leadership and cooperation? 3. Risk of conflict asterisk, is the country likely to be involved in a war, either directly or indirectly? Historical patterns show that neutral countries often fare better than those engaged in conflicts. Even the winners of wars suffer significant financial losses and human costs, while the losers face devastating consequences. These factors guide my approach to diversification, ensuring a balanced and well-considered strategy. When it comes to asset classes, I am increasingly concerned about the capacity of debt-based assets to deliver adequate returns. The heavy monetization of debt by central banks has created vulnerabilities. Many central banks now hold significant amounts of debt, and as losses accumulate, they may need to monetize those losses, which often leads to inflationary pressures typical of late-cycle economies. Debt, after all, represents an asset for one party and a liability for another. In the current environment, a real return of approximately 2% is a reasonable benchmark for a balance point. However, the sustainability of such returns remains uncertain in light of the structural challenges we face. In conclusion, the interplay of these forces underscores the importance of thoughtful financial planning, diversification, and a clear understanding of the risks and opportunities presented by this transformative period in history. A 2% real return is generally necessary to maintain equilibrium, and it's crucial to monitor whether this rate is sustained without triggering a debt squeeze. For this reason, I have a cautious stance on debt assets. They don't appeal to me in the current environment. Instead, I prefer equity assets and believe gold should be a vital component of any portfolio. Gold serves as an alternative form of money and is, in fact, the third largest reserve currency in the world, following the dollar and the euro, and ranking ahead of the yen. Diversification across these asset classes is essential, and close attention to their dynamics is equally important. The key factors I've mentioned will continue to be significant drivers. One of the most critical principles to emphasize is effective diversification. It's essential to invest in environments that foster productivity, which are often found in neutral nations. For instance, the ASEAN countries, India, and even certain Gulf states offer promising opportunities. While the Middle East faces conflict, there are reasons to believe that many Gulf nations are less likely to be directly involved, and these regions exhibit strong productivity potential. When thinking geographically, investments in the United States should remain a priority. However, diversification into new technologies is also critical, as their revolutionary impact cannot be overstated. In terms of leading players in this space, only the United States and China stand out. As such, diversifying investments to include China is a prudent strategy, though it requires thoughtful allocation. Just as with other investments, such as gold, it's crucial to pay close attention to the proportion of your holdings in various locations or asset classes to ensure an even distribution. A balanced approach might involve allocating approximately 10% to each major category or region while focusing on selecting investments that are relatively uncorrelated. This strategy can help mitigate risk while taking advantage of diverse opportunities globally.